I just want to give another quick update on the Repo Madness situation, the new Repo Madness 2021 situation, as the stories and news are coming out fast and furious the last couple days. So we're getting more reports of hedge funds having problems. These are over leveraged hedge funds getting $30 billion in loans from banks or borrowing from repo that they either can't pay back or the collateral was used and reused a bunch of different times. I've heard up to 7 times. I've covered this in the last week or two. And now we're starting to find out, and I predicted this, that the losses from Credit Suisse. Now, initially in the last couple weeks, they said the losses were only going to be 5 billion, and I'm using air quotes here for only, because according to a tweet from a investigative reporter, a financial journalist, Danny Berger, for the entirety of 2020, the net income for Credit Suisse was only 2.8 billion. So a loss of 5 billion was already an enormous amount. Now it looks like, according to a new update Credit Suisse has issued, that their losses just from this one hedge fund, Archegos, is going to be at least $7 billion. So it's looking like Credit Suisse is going to need at some point a Federal Reserve or European Central Bank bailout, maybe a combination of the two. Maybe the European Central Bank will tap those US dollar currency swap lines even more than now. Who knows if we ever find out if they even did. There's been a number of other hedge funds having problems as well recently. You have the hedge fund Melvin Capital, which was short GameStop, and they probably leveraged up those trades a lot too, probably borrowed even more than just normal margin accounts, which are at record highs. They probably went into repo and borrowed there too as well. They lost 49% on their investments in Q1, and then there's problems with Greensill Capital as well. And finally, here in this short little update, we have Scott Minerd, who is a well-known investment money manager, talking about how there's going to be a lot more hedge funds and family offices blowing up with leverage on bad trades. And it only takes a little move in interest rates on the US Treasury on the yield curve when there is 10x leverage involved or more. So a 10 basis point, 20 basis point, 30 basis point move is all it takes when there is that much leverage applied to bond trades or stock trades or derivative trades or foreign currency trades or all types of exotic trades. And especially when the collateral is used and reused and rehypothecated. So this is the problem with the system. I wrote an article warning about this for patrons in the last 3 or 4 weeks. So if you want to read that, it's only $5 behind the paywall. There's also articles behind the paywall about a lot of different topics. There's around 150 articles, might be more than that, on many different topics for only $5 a month if you want to chip in to help pay my bills and keep this content, the free content, going. So the bottom line is the Repo Madness is getting a lot worse. We're getting more details out about it, and the more details that come out, the worse and worse it looks. In terms of the loans, with the Egon von Greyer's tweet that I have in the screenshot there of $30 billion to Archegos, and the losses of Credit Suisse, which are going to end up being a lot more than $7 billion. We may never know the real number for the losses for Credit Suisse. So we may only get some updates in the near future on exactly the amount of losses, but once it starts getting out there that their losses were way more than their net income, it only makes the central bankers and the bank presidents look bad, and then the financial journalists will probably be told to kill the story if they can cover these things at all. The mainstream financial journalists. Maybe alternative financial journalists will be able to tell the truth, but anyone in the mainstream financial media will probably be told at some point to kill the story and stop talking about it. And then the Fed will have to probably do more and more and more emergency liquidity injections to keep the stock market propped up.